What's up, investors? Today, we are going to be talking about an ETF that I like to think of as kind of an underdog. So we're talking about the Satrix MSCI Emerging Markets today, and emerging markets means economies or companies that don't necessarily always get the limelight. So they're not always these big companies that you hear about in the news a lot, or they're in all the major sort of top 40 ETFs. These are companies and countries that kind of fly under the radar, but they may actually have quite a bit of value to offer you for your portfolio. We're going to explore that today. I'm Carly Barnes, your hostess with the mostest, relationship manager at EasyEquities. And joining me today, he's a little bit of a celeb now, I must tell you, my co-host. You might know him as DJ at Large on Twitter. You may also have met him at one of his Youth Money Circle events, which is all about, financial education, or his recent shoot to fame as part of the EasyEquities podcast, which is now at #1 in South Africa. So my co-host today, along with Kingsley Williams, who is obviously you guys, he's also generating quite a fan base now. He's the expert from Satrix who's been helping us with a bunch of these webinars. But my co-host with us today is Tepo, aka DJ at Large. How's it? And welcome, both of you.
Hey, how are you doing?
I'm good. It's so good to hang out with you.
Awesome.
I feel like I need to get your autograph at the end of this somehow.
I need to get yours and Kingsley's as well.
Deal. Okay, cool. So, we've known each other for a while, and I think there's a lot of people in our community who you're a very familiar face to. So talk to me about, how did you start investing? Like, when did investing become a part of your life?
Yeah, so a couple of years ago, I was still in varsity. I was like the cool guy. I was on campus radio and doing promotions and DJing and doing all these cool things. And eventually I moved on to commercial radio. And when I made that move, I now needed to start considering investing because essentially I was working as a contractor, no medical aid, no benefits. And so now I get the salary. Now, what do I do with the salary? How do I plan with the salary? And at the back of my mind, I knew that I needed to plan ahead because, in the industry that I was in, you'd sign like a 1-year contract and then you don't even know towards the end of that contract, are you going to get another one? So I always needed to plan ahead of time. And when I was doing my research, EasyEquities it spoke to me. It was simple, it made sense, it was accessible because investing it always felt like it was for other people. You had to be earning a certain amount, or you had to be a certain type of individual to be able to invest and to even understand what investing is. And my love and my relationship with EasyEquities really began then. And then I just started to own the market and meet cool, amazing people like yourself, Carly, and meet other people within the EasyEquities space. So people that are part of the family, people that are just ordinary South Africans looking to invest. And naturally, Youth Money Circle grew out of that. Me learning about money and then wanting to share it with my peers.
So in some ways, you're like the perfect person to talk about emerging markets because you yourself were an emerging talent and had all this value to offer. And now, boom, you're on the scene now.
100%. So at some point in time, somebody saw some value in me as I see value in this ETF. And then it grows. And, so that's why this makes sense for me. And this ETF in particular is a great fit for me.
So we're going to get into the nitty gritty of that ETF in a second, but I thought something that we could maybe chat around a little bit is this idea, because you said at the beginning of your career, you now are actually starting to earn some money and you've got to make some decisions as to what you actually do with that money. So why not just save the money? Why did you decide that investing was what you wanted to do? And maybe we can just talk about the difference between saving and investing, because I think it can be like a little bit confusing for people. What's the big difference between those two things?
Yeah, it's definitely very confusing for a lot of people. And we actually even use it interchangeably. Sometimes somebody will be talking about investing, but they really mean saving. So I think of three things when I think of saving and investing. I think about time, I think about access, and I think about purpose. So with saving, it's short term. With investing, it's long term. In terms of access, when I'm saving, I want the money now. I don't want complications. I don't want issues. But with investing, I'm sort of looking at the future. So I don't really need access to that money in the current present. And then the last thing I think about is the intention. With investing, the intention is growth, it's value, it's income. But with saving, the intention is I'm going to use the money for something. So I might want to wear some new drip. I might want to buy tires for my vehicle, so that's how I distinguish between the two. But people seem to just like toss them around in the air together. And I guess in some instances it's okay, but when you actually start to invest, you need to start to really invest and start to think long term.
Yeah, and I mean, obviously, I think you've summed it up perfectly. I mean, that there's just a fundamental difference between why you're going to use either one of those vehicles with your money, right? But I think also when you invest, your money has this potential to grow. You've got this potential to get so much more out of it than what you would if you just left it in a savings account. I mean, in a savings account, you're going to get interest from leaving it in that account. And like you said, you need to be able to access that money. So it's not really a long-term thing. And you're happy to kind of sit with a basic interest rate so that you can quickly grab that money for that holiday that you want to book or that wedding dress that you need to buy, in my case. But in terms of investing, in your mind, you're going, well, what you should be thinking is this is super long term. So even though the markets are going to go up and down, I'm prepared to take that little bit of risk because I want this money to grow. And growing means harnessing the power of compound interest. And you do that through investing in the market. So yeah, that's a really good way to kind of see the difference between those two things, definitely.
100%. I know some people are a little bit, some people like to get pictures of what it looks like. The way I like to see it is investing is when you put your money to work. So your money is working in the market. So it's in the JSE or it's in ETFs or whatever the case is. But with saving, your money is on holiday. It's like it's on leave. You'll call it when you need it. And so sometimes that's how I like to see it. So investing, you're putting your money to work, but investing, your money's on leave and you'll call it when you actually need it, whenever that may be.
I like that. That's a really good analogy. So I think it's a good time for us to introduce our other co-host, Kingsley Williams from Satrix. Like I said, he's the Chief Investment Officer there, and he's got loads of experience, guys, with all of this stuff, with the markets, with research, with putting management of portfolios and products. So thanks again for joining us, Kingsley, and being part of this conversation about emerging markets.
Hi, Carly, and hi, Tepo. Thanks for having me, and welcome to everyone listening to this as well. Looking forward to the discussion to talk about it more.
Yeah, definitely. So what I thought was so interesting about emerging markets is I was just reading a little bit about, in general, emerging markets ahead of this conversation. And I was reading something to the effect of COVID and the impact that it's had on emerging markets and how emerging markets could essentially be quite undervalued. So in other words, they're worth more than what they are priced at, as opposed to your more sort of mainstream companies and shares who I think maybe took a bit of a knock when COVID hit. So I don't know if you have any insight around that and what kind of impact that's had.
No, you're absolutely right. And I think if we rewind a little bit to the beginning of this year or the end of last year, the expectation amongst market participants was very much that emerging markets are set to do really well and outperform markets more broadly, such as your developed markets or something like your MSCI World. And the reason for that is exactly as you've touched on. The developed markets have done really well over quite a large number of years, since the global financial crisis back in 2008. And that's really off the back of what's been come to known as quantitative easing, which is really where central banks have stimulated the economies led primarily by the US, but we've seen it play out in Europe and in the UK as well. And that's really favored developing markets and the US in particular, and often at the expense of emerging markets. So the way you're describing it as the sort of the unloved segment of the market is absolutely right. We've actually seen that play out in a large degree, perhaps for different reasons, but to a similar degree in South Africa as well. South Africa is also an emerging market. So it fits within that stable or classification of those fledgling or growing economies that are still not quite at the level of their developed market peers. And so, as I was saying, the expectation was really that they were going to do well into 2021 and beyond. But I think the impact of COVID is still playing a role there in terms of the recovery. We've seen locally in South Africa, it's taken a bit longer for us to get our jabs and for the vaccine program to start rolling out. And that's been the case in other emerging markets as well. We do know the US, for example, has really gotten ahead in that regard. And I hear now people in the UK at our sort of age group are now being vaccinated. So yeah, things have progressed a bit more on the developed market side than they have in the emerging market side. But I don't think that changes the fundamentals of what emerging markets represent as a growth opportunity. And we can perhaps unpack that a little bit more, and also happy to share how emerging markets fit in to the global investment landscape. So back to you, Carly, and then let me know if you want me to unpack any of those things.
Yeah, so when I purposefully didn't go too deep into kind of unpacking the Satrix MSCI Emerging Markets, but one thing I did know is I'm not too familiar with the kind of companies that are in this ETF. So maybe we can talk about what companies make up this ETF, what's inside it, how are they chosen, and talk a bit more about, like, how do you define an emerging market? Like, give us the official definition.
Okay, I'm going to do that, and as usual, share a visual just to help the discussion along. So that's, I trust, coming through. And yes, you will recall that I shared something similar when we were speaking about MSCI World in 2 webinars ago. So the important thing with MSCI World is it covers what we call developed markets. So these are what's otherwise known as first world economies, with the US in particular dominating that portion of the global landscape. So, but you touched on an interesting question, which is how are the companies that that get into these indices, how are they decided upon? Who decides that they get into the index, and how are they weighted within the index? So this is really what this table in a very simplified form is trying to show. You'll see here on the left here, there's large and mid, or large and medium. So this really refers to the size of a company, and by size, we mean its market capitalization. So, okay, that's a big word, or 2 big words. What does that actually mean? So every company trades at a price on the exchange, and its market capitalization will just be a function of multiplying that price by the number of shares that that company has in issue. There's some other technicalities about the number of shares that investors are actually able to trade. So they strip out things like strategic shareholders that are not actively trading those shares to get what they call a free float. But essentially, it's the number of shares that the company has multiplied by its share price. And that will then determine how large a company is according to its market capitalization. So the larger a company is, the higher the weight it will have within an index. Now, what I've tried to do with this visual here is to sort of make it large, roughly proportional to the size that large caps represent versus mid caps. And you can see the bigger companies make up a much bigger proportion of the overall index than the smaller or the medium-sized companies. I've also tried to make the size of these blocks proportional to the size of the US relative to the global investment landscape. So the US I've just proxied here with S&P 500. As I mentioned in the previous webinar, S&P 500 is just large cap companies. So that's why it's only occupying the top section here. You may also know of the NASDAQ index. Satrix has a product tracking that index. That's also US only, but only a subset of the US, also in the large cap space, only stocks listed on the NASDAQ exchange. But I think that's enough about developed markets. Let's move the focus to emerging markets.
Let's speak about the little guys. I like it.
Exactly. So these are all of the economies and countries that are not classified as first world. So just as a reminder, your first world countries would be the US, Canada, most of Europe, the UK, Japan, Singapore, Australia, etc. So those are your largest developed market countries. Emerging markets would be the types of countries similar to South Africa in many ways. So your largest one is actually China, and I've put that there. There are about 700 stocks in the China index, and China actually makes up about 30% of emerging, or almost 40% of emerging markets. Okay. And then, so that's the largest country within emerging markets. And I'm going to talk a little bit about the difference between how size is measured within an investing context using market cap, which I described earlier, versus the actual true size of these economies. Because when you measure an economy, you talk to its GDP or the GDP per capita, and also how that GDP is growing through time. Whereas what this visualization is showing is how large these markets are on the stock exchanges and the companies listed on the stock exchanges within those markets. The other thing I wanted to mention as well is that South Africa has about 140 stocks. Not all of those 140 stocks are in this emerging markets index, but our JSE All Share Index has about 140 stocks. But South Africa within that emerging markets index is only the 6th largest country. So I'll show you on this slide just what those countries look like, just from a graph perspective. So you can see China there at about 38%. You've then got Taiwan, South Korea, India, Brazil, and there's South Africa, the 6th largest country. So I'm just going to jump back to this slide, because what's interesting is that within emerging markets, South Africa is only about less than 4% of the emerging markets universe. So, you know, there seems to be a lot of opportunity locally, and the JSE can seem quite daunting, but when you start broadening that universe, you can see there are about almost 1,400 companies in the emerging market universe. I mean, it's absolutely vast. And South Africa is actually a tiny drop. And then if you look at, you know, collectively South Africa versus developed and emerging, then we make up only 0.5% of that that entire opportunity set, which is in MSCI terminology known as ACWI, or All Country World Index.
Learning a lot here.
So the other thing I wanted to just finish up on, Carly, on this particular slide is that the index that Satrix tracks with its ETF actually includes the small cap stocks as well. So it's known as the Emerging Markets IMI Index, or Investable Market Index. It's essentially all of the shares that are available for investors to access. So it includes not just the large and mid cap companies, but also the small cap companies. So you actually get an index with, what's that, close on 4,000 stocks, sorry, 3,000 stocks that you would have exposure to. So an absolutely enormous investment opportunity set.
Wow. And what I really like, even just looking at that other slide where you showed us the countries, I mean, I just wouldn't even know where to look for those kind of opportunities on my own, which is why I'm such a fan of exchange traded funds, because, you know, they put the selection together for you. You don't have to go and investigate, okay, which are some interesting emerging markets companies in Mexico. I wouldn't even know where to start. So you are capitalizing on the opportunity that comes with investing in emerging markets without having to go and kind of explore these companies and brands that maybe some of us haven't even heard of before, but that could offer great potential for your portfolio.
Exactly. And I think one feature that is quite telling within an emerging market context is, and we'll know this firsthand living in one, is that the risks between different countries and the investment opportunities between different countries are quite stark within an emerging market context. A lot more so than you would find within your safer developed markets, where well-established institutions and governance and all of those good things, there tends to be a lot less variation in performance between developed market economies within the MSCI World context, but a lot more variation in performance across emerging markets. And that's because they have unique socioeconomic and political issues affecting that specific country. They're still developing economies, so it stands to reason that those would be the issues. But an important point with investing is that for every risk, there needs to be a compensating reward. So if you're going to take the additional risk of investing in emerging markets, which have these socioeconomic and political risks, you would expect to be compensated for taking that risk through a higher return. And so that's really where emerging markets have a unique role to play within constructing your portfolio, is that you would hope to get those higher returns, and you should reasonably expect to get higher returns. Otherwise, why take the risk? And that's really what emerging markets promise. And I'll show you that on some slides in a moment.
Yeah, I think that that's a really good point to make. I mean, Tepo, maybe you can weigh in here just around your portfolio and risk, and why did you decide that this was a good ETF to have in your portfolio? I mean, we know that any kind of investing comes with risk, but it's that very risk that can offer potentially higher returns, and that is why we do it. So was it like that for you? What was your thinking?
Yeah, for me, especially when I started out, because I had such little money, I was more willing to risk that money. So I wanted it to grow, and I had the opportunity to take those kind of risks. And I think even COVID-19 has provided that opportunity where it's almost like a reset button. It's like, if you're ever going to make a jump and take a risk on investing in these types of markets, this is the time. So that's why I'm continuing to even pour more money into those kind of ETFs and to allow my money to travel to all these different countries where there really is opportunity. But with opportunity comes great risk. And so the idea of being patient is also very, very important, as would be with any sort of investment.
I think you've hit the nail on the head there. So, if that is something you're going to do, I sleep better at night knowing that when I take those risks in my portfolio, that I'm in this for 10, 20, 30 years. I'm in it for as long as I can possibly be, so that when things go up and down, I'm not, it doesn't freak me out. I don't lose sleep over it, because I know that ultimately I've got so long to recover from it, if that's the case. So yeah, so speaking of performance, Kingsley, maybe you want to get back to your graphs and show us what's this thing done? How's it looking?
Absolutely. So I just wanted to touch on one other key point, which is that emerging markets actually, as large as the developed markets appear, in what I showed you in that first slide with the different blocks, as large as MSCI World is relative to emerging markets. In fact, emerging markets only 13% of that entire opportunity set from a market cap perspective. 86% of the world's population actually is living in an emerging or even one tier below that from a population perspective in an emerging market country, or there's countries also known as frontier markets, which are not even classified as emerging markets. And from a GDP perspective, they actually represent the majority there's this term known as purchasing power parity, which just basically takes out the exchange rate effect and looks at it from a cost of living perspective, represents the majority of global GDP, close to 60%. Yet such a tiny portion of the investable opportunity set. So again, that really talks to the potential growth that exists in emerging markets versus developed markets. Growth can't go on indefinitely. There's a limit to how large something can get. There are only so many people to serve, but there's a lot more growth opportunity amongst the emerging markets than there would be, say, within the developing subset. So let's just share this again.
That's a really interesting point you made. I never thought of it like that in terms of the populations. That's very interesting.
So I've shown you these charts before when we were discussing MSCI World, and this is how it's performed in dollars through time. And you'll see, particularly when I show you the other charts. So remember, I showed you how South Africa's done in dollar terms. So South Africa, an emerging market, over a long period of time has outperformed a lot more than developed markets have. But you can see with the slope of this chart, given it's a log chart, how that gap has been closing between South Africa versus developed markets. And that's what I mentioned at the beginning around the quantitative easing that developed markets have implemented, which has really favored their stock markets and their asset prices, which is why you've seen this gap closing over the last 10 to 12 years. We also spoke about how the rand tends to weaken dramatically. You can see here with this arrow that when the dollar strengthens, the rand weakens, particularly during periods where there's market stress. And you can see that with the dot-com crash there, with the global financial crisis there, and then again with COVID last year, how the rand weakened, but then subsequently recovered. And it's done that repeatedly through its history. So let's throw in emerging markets to the mix. And you can see that the profile, which is this orange line of emerging markets through time, has been actually quite similar to what we're seeing from South Africa. Rapid growth pre-global financial crisis, outstripping the growth by a long margin relative to what developed markets have delivered, but more muted growth since the global financial crisis. And I think this talks a lot to the opportunity set that emerging markets represent. I mean, just out of interest, over the last 10 years, developed markets have delivered about in terms of market returns, about 10.5% per annum. So that's this blue line that I'm showing here. Whereas emerging markets have delivered about 4% per annum, and South Africa only 2.5% per annum, all in dollar terms. But if you look at the growth of emerging markets, looking at their GDP, it has been over 5% per year versus developed markets, which have only grown by about 2% per year. So you can see emerging market economies are growing a lot faster on the ground. It's just not yet being reflected in their stock market valuations yet. And that's really what talks to that upside potential and the disconnect that exists between the size of emerging markets from a stock market perspective versus the opportunity that those could grow to with time. The other thing I wanted to just also highlight, which you can kind of visually see on this chart, is that emerging markets would tend to correlate more closely with South Africa, given South Africa is an emerging market itself. And you can see that, the green line and the orange line have moved a lot more similarly to one another relative to how they've moved, for example, to MSCI World, which is the blue line. So you wouldn't necessarily invest in emerging markets from a pure quantitative or finance diversification perspective, but you would invest in emerging markets to get diversification of growth. So you wouldn't want all your eggs sitting in South Africa as your growth engine because you've got phenomenal growth opportunities in other emerging markets as well. So you're diversifying your growth, even if the nature of those returns tend to be more highly correlated with one another, as you can see between the orange and the green line.
Okay,
so,
let
me pause there. Thanks.
What do you think of that chart, Lodge? It's looking not so bad, huh?
Not too bad at all. Not too bad. It makes me want to buy a little bit more, actually.
Yeah. And I think that's always what we're trying to do. I mean, I've been waiting to see what I'm going to purchase next for my tax-free savings account. And I'm just thinking in terms of like growth and having those sort of potentially fast growing ETFs in my TFSA, this could be something that really like gives it that boost potentially. Kingsley, I've got another ETF in my TFSA. I've got a momentum ETF, which is essentially, as I understand it, these are companies that are undervalued, or they seem to be companies that are going to have growth spurts. How would that be different from an emerging markets ETF?
Okay, so the momentum ETF that you're referring to, if it's the Satrix Momentum ETF, that one is focused specifically on South African stocks and looks at companies that have been performing well over the last 6 to 12 months. And finance research and academic research suggests that companies that have done well over that time period tend to continue to do well as investors react to whatever has caused those companies to start doing well in the first place and re-rating. It tends to continue longer than investors. It tends to continue longer and tends to play out over a longer period of time. So that investment strategy specifically focused on South Africa and looks at companies that have done well over the recent past on the basis that that is expected to continue into the short to medium term in the future. An emerging markets ETF, however, is looking not specifically at a momentum strategy, but is looking at a subset of the market where the actual fundamentals, the underpin, is growing quickly. And we've spoken about how the GDP rates are improving. And really where it comes down to, or what it comes down to is this key measure of what we call, I don't want to make it too economics because I'm not an economist myself, but it's this.
Do you think that's a sign we shouldn't get into economics?
I think it might be.
Okay, so we've got a couple of questions that have come through from our audience. So I'm going to actually just jump in and answer one of those questions. The question that we got was, what is the benefit of investing? So I think we spoke a bit about that in the beginning, Large, about versus savings. But I think in a more general sense, I could sort of step in and say, the benefit of investing is that you have the opportunity not just to save your money and have it kept aside so you don't spend it, but to actually have that money grow and get even more. So it grows in value and becomes worth more than what you originally bought it for. So let's use the example of a house. Let's say that you buy a house and you buy it at 100,000 Rand. It's a very cheap house. And in 10 years' time, that house, if someone wanted to buy that house, your estate agent comes and does an evaluation and says, okay, cool, that house is actually now worth 500,000 Rand. Then over the course of those 10 years, you've actually increased in value on that house to 500 Rand. And so you would have made, if you're able to sell your house, you would have made a 400,000 Rand profit. So I think about investing and why there's a benefit to it in the same way. If you had invested in a share like, I'm going to use the example of a Capitec share, when they first listed, maybe it would have been worth 15 Rand. And today a Capitec share probably is worth somewhere around 1,300 Rand. So you see, if you'd invested in it when it was low like that, you would now be able to sell it and get a profit for just holding on to the share, for just, having it and being a shareholder. And why I really like that as a way to kind of prepare for your financial future. And there's a lot of different ways to do that. There's a lot of different ways to grow your wealth over the long term. But investing has been shown historically, if we look back on years and years of data, it's been shown as the best way to grow your wealth. And why I really enjoy it is because it's a low maintenance way to grow your wealth. So for me, I'm not someone who wants the hassle of owning a house and looking after it. And when I invest, I just have quick, easy access to all of my assets. I can look at them, I can see how they're performing. I have more involvement in it. And it's a really effective, low maintenance way for me to build my wealth. That's why I see a benefit of investing. I see Kingsley, you're back. We jumped in with a few questions and I was just sharing about some of the benefits of investing. But I think if you want to just pick up where you left off, you started talking about economics, but then we decided the internet didn't want you to talk about economics.
Maybe the internet didn't like my topic or thoughts on that matter. So. But I think all I was trying to say was that the, as the wealth of an economy grows, that wealth filters down to how people spend that money. And that's ultimately what then translates into the stock market within that country growing. And that really talks to the growth potential. I think the other point I just wanted to mention as well is that, that quantitative easing, low interest rate move that has been implemented with developed markets has sort of run its course. We're not sure how long those rates will stay low for, but there's not really any lower they can go. So, you know, with the economies globally recovering, and particularly, you know, as the vaccinations get rolled out, and as they are starting to be rolled out in South Africa and other emerging markets, that bodes well for a strong recovery across emerging markets. So I think having exposure to this asset class within your broader portfolio is not something you can ignore.
Laj, do you have any questions for Kingsley? Because I think that's it from our audience. Guys, if you are joining us live and you've got questions, please pop them in the Q&A at the bottom and we'll get to them. We're going to have a few more minutes for that. So take the gap. Now's your chance. Tepo, is there anything on your mind that you wanted to ask?
You know, I was just thinking about the question that we received in terms of the benefits of investing. And I think you mentioned the financial side of it, but I was also thinking about the emotional, mental side of investing. And I'll give you a very good example. The other day I was in Woolworths, and I've got a couple of Woolworths shares, and there was a long queue and I was getting a little bit irritated. I was like, but then I realized I actually own a share of this company. I own a little bit of it. And mentally, ownership means a lot to me personally. And so to own a share of an organization, and you don't necessarily have to work for them, but you share in the success of that organization. For me, it meant quite a lot. So yes, there's the financial side of it, but there's also the side of I go to this place all the time, or I use this product all the time, and I actually own a piece of it. So even from an emotional and mental side of it, investing also has that effect. And I think with the ETFs, it's all about that as well. You're seeing these countries and these organizations grow. And as they grow, yes, there's the money aspect, but there's also an aspect of my money's in Brazil and it's doing really well. It's in Mexico, it's doing really well. It's in China, it's doing really well. I might not be there physically, but my money is there and it's there to build my wealth, to build my portfolio. So that's what really is on my mind at the moment.
When you put it like that, it makes you sound like a mogul, dude. Like you got stuff going on around the world, yo.
and that's exactly what it is. I mean, you don't have to invest 100,000 Rand, even 1,000 Rand, even 10 Rand really means that you're a mogul. It means that your money is traveling around the globe and it's working very, very, very hard for you. And there's people like Kingsley that are doing all the hard work in the background. They're the ones that are deciding this is where the money should go. And all you need to do is just sit back and relax and enjoy the ride.
Yeah, ETFs for the win. I'm telling you, ETFs for the win. Okay, guys, well, I think that's a good place to leave it. So if you're interested in your money traveling around the world to some of these economies that are just looking to grow even more with these huge populations, then the Satrix MSCI Emerging Markets ETF is definitely one you want to consider. Thank you, everybody, for joining us today. As always, we'll have the recording of this up on our YouTube channel, so be sure to go check it out there if you want to go back, take notes, stalk us. I mean, what can we do? Thank you, guys. Thanks for joining. Thanks, Kingsley and Laj. You guys rock.